this one. Okay, this work. Okay, now let's see. I think I would like to start the lecture from this slide. Lecture 1. Okay, lecture 1, which is the monetary policies. I think from the last times, we talk about the monetary policies, the open market operation. And then, okay, this is the slide from our previous class. Okay. From the previous class, I talked about the component of the money supply. We use M1 as the money supply. Okay. M1 consists of currency in circulation, banknotes, coins, circulated in the general public, okay, in the hand of the general public. And the second component is the demand deposit. Demand deposit is the deposit that the depositor deposit at the commercial bank. Okay, and as you can see for this one, and if you can recall, I told you that the first part here, currency in circulation, can be labeled as the M0. Okay, M0. M0 is the most liquid asset in the world. Okay, which is cash in your hand. That is the most liquid asset in the world. We typically when we experience the recession, economic recession, we tend to say that cash is king. Okay, cash is king. Why? Because it is the most liquid asset in the world. And as you can see from COVID-19, many firms or many business firms try to collect cash. Okay, try to collect the cash by operating the business. Okay, so M1 can be divided into M0 plus demand deposit, or here it is currencies plus demand deposit. And the next one is the monetary base. Monetary base can also be divided into two main parts. The first part is also the currency in circulation, and the second one is reserves. Okay, and after this, we will derive the relationship between the money supply and the monetary base. That is, we try to link between the monetary base and M1. Okay, monetary base and M1. Now let's see. This is the derivation, but anyway, I will write it down here because you can follow the state of the derivation. Let's see. If you have any questions, you can ask me. Don't hesitate to ask me. What happened to this? Okay, I completely understand that this is Sunday morning, but anyway, this is what we have to do for the class. Okay, for this one, I will try to derive the relationship between the monetary base and the money supply. Okay, let's see. So, first, let's start by the money supply. I will use M as the money supply. Money supply can be divided into currency and the demand deposit. And as you can see from the multiple deposit creation process, when the demand deposit or when the deposit increase in the banking system, it also increase the money supply. And when the money supply increase or decrease, it will directly affect the direction of the short-term interest rate. Okay, the short-term interest rate. Okay, let's see next. What next? The next one is the monetary base. We use MB equal currencies in circulation plus reserve. So we will link M and MB together. Okay, we will link M and MB together. So let's first start by this equation. I will call this equation 1. Okay, equation 1. And for these guys, okay, equation 2. We have equation 1 and equation 2. monetary base equal currency in circulation plus reserve. For this one, we will see that this guy is reserve. In fact, it is total reserve, okay? Total reserve in the banking system, okay? Total reserve in the banking system. So for the total reserve, it can be divided into excess reserve plus required reserve, okay? These components are in the banking system. I talk about excess reserve and required reserve as a whole, okay, as a whole. We mean in the banking system, okay, we mean in the banking system. And what's next? Let me define the new variables, little c here. Little c here equal total currency in circulation divided by the demand deposit, divided by the demand. Okay, yes, demand deposit. And we have here ER. I think in the lecture note I use little e, but anyway in this in these writings I will use ER instead of little e, okay? Because this one stands for excess reserve. Excess reserve. Sorry. This guy's excess reserve divided by the demand deposit, okay? Excess reserve and currency, okay? And the next one is the RR. For the RR, as you know, this is the RR for the whole system. So for this guy, it's set equal to deposit multiplied by, I think I used little r in the slide. For this one, it is the required reserve ratio. This one is set from the central bank, okay? It is set from the central bank. We call this little c the currency ratio. The currency ratio. For this one, we call it the excess reserve ratio. Okay, the excess reserve ratio. For these guys, as you know, we call it the required reserve ratio. So I just plug everything here in this equation. As you can see, for this one, it is a capital letter C, right? So you can rearrange this relationship into this form. Little c multiplied by d plus here er, little er multiplied by d. And we also have this guy's total required reserve in the system. So for this guy, it is multiplied by d. We have d as the common variables here. We have d as a common factor here. So we can pull d out of this equation. So what we have now is this one. Okay, this is the relationship. If you cannot follow what I said, you can see from the slide, because I just bring everything from the slides into the reality. Okay. I would like you guys to try to derive it by yourselves, because you will have to use it in your final exam for sure. Okay, now let's see what next. For this one, we can summarize it as the monetary base equals C, little c plus little er plus little r multiplied by demand deposit. Okay, and what next? This is equation 3. Okay, now let's move on to the equation 2. In equation 2, what we have is the money supply equal currency in circulation plus the demand deposit. Okay, plus the demand deposit. for this guys, C, it is a capital letter. So we can change it into a little c. Okay, so for this one, it should be little c multiplied by demand deposit here plus demand deposit here. So you can see that the here is a common factor, so you can pull it out of the equations. What you will get is here. We have here the equation 4. So now you can link equation 3 and equation 4 together. Okay, you can see that the sole purpose of this derivation is to link M and MB together. So now you can see that we can link both equations through demand deposit. Because we have the demand deposits on your left hand side for both equations. Okay, here is what I try to derive. But for these ones, you can rearrange the equations by this. Let's see. C plus 1 over C plus little er plus monetary base. For this guy, you can treat it as a parameter. In the lecture note, I think I use a little m, okay, multiply by monetary base. And for this one, equal m, which is the money supply. We call this guy the money multiplier. Little m here is the money multiplier. Why we call it multiplier? นี่คือวันนี้มี2ข้ามนะคะเช้ากับบ่ายใช่ค่ะสอนที่เดิมตลอดค่ะแต่ผมเซ็นแค่ตอนเช้าอย่างเดียวนะหรือเซ็นอ๋อเซ็นทั้งคู่ค่ะเซ็นเริ่มเซ็นไม่ถูกแล้ววันนี้วันอาทิตย์มันต้องเป็นวันหยุดขอบคุณค่ะ Okay, now let's see. From your backgrounds in the FN211, you may know that for this one, it is the dm by dmv. Okay, we use the different differentials. We use the definition of the differential. Okay, for this one, it is m. You can see that when mv increased by, let's say, 1 baht. 1 baht here can be translated into m baht for money supply. Okay, and m tend to be greater than 1. M here tend to be greater than 1. That is why we call it the multiplier. Okay, that is why we call it the multiplier. You increase the monetary base 1 baht, it will increase the money supply greater than 1. Okay, so that's why we call it the money multiplier. Okay, this is the whole stories of the derivation of the relationship between the monetary base and the money supply. And what you have to know is, because this is the intuition behind the equation. And for this one, you can see the merit of the money multiplier because it's equal to currency ratio, right? Plus 1 over currency plus excess reserve ratio plus the required reserve ratio. In fact, you can uh, interpret the changes in the currency in circulation. I mean the capital letter C, because capital letter C is set equal to the um, little c multiplied by d, right? So you can see that what will affect the money supply when the currency in circulation increase. Because when the currency in circulation increase, it means that the holdings, the currency holdings of the general public increase. People tend to hold money in terms of currency rather than the deposit. So C increase, and you can see that when C increase, it will somehow lower money multiplier, and then you will have the lower money supply when people or the general public try to hold the currency rather than the demand deposit. Okay, rather than the demand deposit. For this one, ER stands for the excess reserve ratio. Excess reserve ratio. And you can see that when the commercial bank try to hold the money in terms of the excess reserve, rather than lending that money out, the bank try to keep the money with them. Okay, so for this one, ceteris paribus, I mean that set everything constant. When ER increase, it also decrease the money multiplier here, and the money multiplier here will affect the level of the money. The money supply. Okay, the money supply. So when the banks or when the commercial banks or financial institutions try to hold the money in terms of the excess reserve without lending to the general public, this will lower the money supply. Okay, this will lower the money supply. And the last one, required reserve ratio. Let's set other related factor constant. So I put bar over this guy, and let's relax this required reserve ratio. Suppose that the central bank try to increase the level of the required reserve ratio. It means that the banks will have to keep a fractions of the deposit, right? Keep a larger fractions of the deposit with them. So when I here increase, it also decrease the money multiplier, and then it will lower the level of the money supply. Okay, here is the stories behind the money multiplier. The story behind the money multiplier. Okay. Now let's get back to our slides. If you cannot catch what I say, I write everything down in the slide, so you can read from the slide. Can I switch back? Okay, I think I can. Now let's see. Here is the stories. This one is the main equation that I try to explain to you, and this is the summary. The summaries of the relationship. For this one, I took this table from Michigan, and I think I just gave you Michigan in TU Moodle already. It is a textbook that you can use for your quiz 1 and quiz 2, and you can use this textbook in preparation for your final exams. Okay. Now let's see the table together. I would like to draw your attention to this guy first. Here in the slide is a little r here in my derivation. You can see that when the required reserve increase, it will decrease the money multiplier, and then it will also reduce the money supply. So when RR increase, keep other variable constant, money supply will decrease. Okay, and so for the next one is the excess reserve here. I will explain MBN and BR in the next few minutes, but for this one, I would like to explain RR, excess reserve, and currency holdings first. For the excess reserve, as you can see, when the excess reserve increase, it means that banks try to hold the money with them without lending. So that's why we have the lower level of the money supply. Okay, this one is from the bank. Okay, this one is from the bank or the financial institution. But for the next one, currency holding, this one is from the general public or from the non-bank. Okay, from the non-bank organization or non-bank entity in the in the economy. You can see that when the currency holding increase, people tend to hold the money in terms of currency rather than deposit the money with the bank. So this one will lower the money supply. This one will lower the money supply. Okay, now so we left with the MBN and BR. What is MBN? MBN here stands for non-borrow monetary base, and here BR stands for borrow reserve. In fact, I try to explain these two variables in this slide. So let's see what are they. Okay, MBN and BR. Now let's switch to the visualizer again. Okay, as you know, I believe that as you know, monetary base equal what? Currency and reserve, correct? Okay. You can think of monetary base here as the MBN, okay? MBN plus BR. Why? Because for this one, if I rearrange this equation, MBN, we call it the non-borrow monetary base, will be set to equal monetary base minus borrow reserve. Borrow reserve here. This is the total monetary base. Okay, for this one. This component is the component that the central bank can fully control. Okay, can fully control. It will be, the central banks will perfectly control this component, or nearly perfect. Okay, or nearly perfect in terms of controlling the components of this one. So for this one, we call it the non-borrow monetary base. Because for this one, if you remember from our last class, I think I talked about the balance sheet, right? The balance sheet between the commercial bank and the central bank. And I talked about the open market operations, okay, the open market operations. So when the central banks conduct the open market purchase or when it conduct the open market sales, this will directly affect this guy, monetary base, which is a non-borrow monetary base. Okay, non-borrow monetary base. But for this one, what is it? It is the borrow reserve. Okay, this is the borrow reserve. Why? Because as you can see from the commercial bank balance sheet, the reserve here, when the commercial banks experience the liquidity problem, if you can remember from the banking management, the commercial bank can borrow from whom? It can borrow from the central bank. It can also borrow from the central bank. That's why we still have a fraction called the borrow reserve. Because for this guy, a commercial bank borrows from the central bank. And this component is a component that a central bank cannot fully control. Because for this one, it will be dependent to the borrowing behavior of the commercial bank. Okay, it will be dependent to the borrowing behavior of the commercial bank. But for this guy is the central bank can fully controls or nearly perfect control for this one. Okay. So for this one, what will happen to our relationship to the money supply? As you can see, we can treat monetary base equal to non-borrows and borrow reserve. Okay? Non-borrow monetary base and borrow reserve. So from our relationship, we have the money supply equal the money multiplier, little m. Okay, multiplied by monetary base. But the monetary base here can be divided into non-borrow monetary base plus borrow reserve. So from our algebra at the rudimentary level, you can see that for this one, it is m multiplied by monetary base here. Non-borrows plus m multiplied by the borrow reserve. So what will happen? As the non-borrow monetary base increase, it will also increase the level of the money supply. We also have the same story with the borrow reserve. When the borrow reserve increase, it will also increase the level of the money supply in the economy too. Okay, here is the stories behind the relationship. And so what we are talking about, now is the determinants. The determinants of the money supply. The determinant of the money supply. Okay, we are talking about the factors that will affect directly, indirectly the level of the money supply. Why we care so much about the money supply? I think from our previous class, I told you already about when the money supply changes, it will also affect the short-term interest rate. And when the short-term interest rate changes, it will directly affect the real economic activity in the short run. Okay, in the short run. So that's why we have to, when we talk about the monetary policy, we have to understand these factors that influence the level of the money supply. Are you still with me? Okay, anyway, I will try to finish the class as soon as possible because I want you guys to prepare for your presentation. Okay, you can follow these topics for your revision when you prepare for your final exam. Okay, finished. Next, you still have this one. This is the next slides that you can find it from the TU Moodle. Okay, so let's see. And for this topic, it is a new topic, but it's still under the same under the old umbrella that I try to cover, which is the money, the topic of the monetary policy. So when we talk about the monetary policy, you can think of it as an umbrella term, and it will cover these topics too. So let's see. For this one, I will skip this exercise and I will let you guys to think about it as your maybe your hobbies. Okay, you can think of it as your hobby. Okay, now let's see. For this one, I will talk about the monetary policy tools and the effects of the monetary policy tools in the market for research. Okay, in the market for research. If you live in the US, this topic is all about the factors that determine the movement of the Fed fund rate. Okay, what is Fed fund rate? Fed fund rate is a short-term key policy rate. It might be the most powerful interest rate in the world. Okay, it might be, I use the word might be, the most powerful interest rate in the world because the Federal Reserve System use it to intervene or use it to maybe to stimulate the economics, the economy in the short run. Okay, the economy in the short run for the US, and the US is a very large countries, large and open economy. So that's why it will also affect the other countries also around the world. In Thailand, when we talk about the characteristics of the macroeconomy of Thailand, we will call it a small open economy. Okay, a small open economy. But for the US, it is a large and open economy. So we are different. And this topic is also this can be applied to our Thailand's context because when we talk about the key policy rate in Thailand, it is also determined in the same fashion as the Fed fund rate, or nearly the same. Okay, nearly the same. What is the key policy rate for Thailand? Any ideas about this? What is the key policy rate for Thailand? Yes, that is a 0. Okay, thank you. Sorry, I may ask you the wrong question. What is the key policy rate? What is the key policy rate in Thailand? How can we call it? Or what is its name? We call it. Thank you very much. We call it the RP 1 day. Let's see. BOTORTH. We call it the RP 1 day. We use the RP 1 day. We use the RP 1 day as a short-term policy. But I don't know how to convert in English for this one. Here is a key policy rate for Thailand. Oops. The 1 day repurchase. This guy is the key policy rate in Thailand. It is when you compare the interest rate, the key policy rates of Thailand and the US. This guy is the 1 day RP or the RP 1 day rate or 1 day RP is the interest rate that share the same hierarchy with the Fed fund rate. Okay, so this guy is it is different from the Fed fund rate, but it shares the same level of the Fed fund rate. Okay, so the central banks will when they have the monetary policy committee meeting, they will have to make decisions on the directions of the 1 day repurchase rate. Okay, the 1 day repurchase rate. So this guy is the key policy rate for Thailand. Okay, 1 day repurchase. Now let's get back to our slides from the textbook. It is a little bit, I think it is really boring because it is very classic and very old content. But anyway, you have to study. We have 3 tools of the monetary policy. The first one, I think you guys are familiar with this one. It is the open market operation. Open market operation is the most important monetary policy tools because the central bank conduct the open market operation every day. It's conduct on a daily basis. Okay, it conduct on a daily basis. The second one is the borrow reserve. The last one is the reserve requirement. When we talk about the reserve requirement, I would like you guys to think about the required reserve ratio. The required reserve ratio, because the central bank can set that number, okay, that fraction or that number, that ratio. Okay. But here in our contract, we use the 1 day repurchase. But from this slide, I took it from the Michigan. Michigan just used the key policy rate for the US within the federal fund rate. Okay, within the federal fund rate. So you can replace the federal fund rate to the 1 day repurchase. Okay. Okay, now let's see. Anyway, let's see the mechanism because it shares the same mechanisms all around the world. But the titles or the names of the interest rate may be a little bit different, and the transaction may be a little bit different too. But anyway, understand this one will give you a big picture of the whole advantages of the what happened in the market for research. Okay, what is the Fed fund rate? In fact, it is just an interest rate. Okay, but it is an interest rate of the overnight loan. It is very short term. Okay, very short term overnight loan. But it is the overnight loans of the reserve. Okay, so this rate is the interest rate that bank will charge another bank. The interest rate that the bank will charge another bank if that bank borrow the reserve. Okay, if that bank borrow the reserve. So this is the interest rate on reserve. So when a bank holds excess reserve, it will have the opportunity cost, which is the Fed fund rate. Okay, which is the Fed fund rate. Okay, let's see. When we talk about these monetary policy tools, we will link the tools to the market for reserve. Market for reserves. And when we talk about market, we implicitly talk about the demand and supply. Okay, the demand and supply. The invisible hand. Okay. So let's see, what is the demand of the reserve? As I mentioned earlier, when we talking about the reserve, here we mean the total reserves in the system. And the reserves here in the system can be divided into the required reserve and the excess reserve. Okay, the required reserve and the excess reserve. Especially this component, the excess reserves. The holdings of the excess reserve will cost you the opportunity cost, which is equal to the Fed fund rate or equal to the short-term interest rate. So the cost of holding this reserve is the interest rate. Okay, and this interest rate is the key policy rate. Okay, is the key policy rate. To put it simply, when we're talking about the monetary policy tools, especially the open market operation, it means that we are talking about the transaction in the market for reserve. Okay, because when you can change the supply or change the demand of the market, when you can change the demand and you can change the supply of the reserve, okay, it will directly affect the short-term interest rate, or it will affect the key policy rate. So that's why we have to understand the mechanism behind the market for reserve. Okay, let's see. As you know that here, the Fed fund rate, which is the key policy rate, is the opportunity cost of holding the excess reserve. So as the rate increase, as the rate decrease, the opportunity cost of holding excess reserves also decrease. Okay, the cost of holding decrease. So you can see that the quantity of reserve demand will rises. I think it would be better to show you the graph. Oops, this one come together. For this one, I should write down. Sorry, I think I should write it down here because I can take a photo. I will talk about the demand. Now let's see. Okay, for this one, we will derive the demand. We will derive the demand for reserve. When we are talking about the market, I think you guys may study lots of the market. So in the very general market, we have here are the price, okay, and here are the quantities. The price of goods and services, here the quantity of goods and services. But for this one is the market for reserve. So the quantity here is a reserve. Okay, it is a reserve. So the price here is the opportunity cost. Okay, the opportunity cost, which is the short-term key policy rate. So to make it consistent with the slide, I will use the IFF. FF stands for the federal fund rate. Okay, FF stands for the federal fund rate. Okay, this is the cost of holding the excess reserve. When the interest rate goes up, it means that the cost of holding excess reserve increase. The cost of holding excess reserve increase. So the bank will find it very costly to hold the excess reserve. As a result of this, let's use this as a reference point. As a result of this, the bank will have the lower demand, okay? Lower demand for reserve. The demand here, we mean the demand for holding reserve with the bank. The demand for holding the reserve with the bank. So when the interest rate here goes down, the cost of holding the excess reserve with the banks is lower, right? So the demand for reserve here will go up. Let's say this guy is point A, this guy is point B. This goes up. Remember that the demand for reserve here, we mean the demand for holding the reserve. The demand for holding the excess reserve, sorry, the demand for holding the excess reserve. So when you connect the dot, you will have this downward sloping. We call this the demand curve. Okay, it is the demand for reserve. Okay, the demand for reserve. When we talk about the reserve here, I would like you guys to bear in mind that we need the required reserve and excess reserve. But the required reserve cannot be changed. The excess reserve can be changed in this situation because it depends upon the borrowings and lendings behavior, right, of the commercial bank. So that's why I use the word total reserve, or sometimes I use the word excess reserve. But I would like you guys to know that I mean the same portions of the reserve. So this one we have the downward slopings of the demand for the reserve. Okay, this is the demand curve. Here, remember that it is the cost of holding the excess reserve. Okay, what next? Let I switch back to the computer. For this guy, the next one is the supply of reserve. Okay, here we have the downward sloping as I defined. The next one is the supply. For the supply curve, it is a little bit tricky. Because for the supply curve, you need to think about the reserves as the non-borrow and borrow reserve. For this one, you can think of this as the BR. Sorry. For this one, borrow reserve, you can think of this as the BR in your monetary base equation. In the monetary base equation that I just write it down here for you, you can think of it as a BR, okay, as a BR. But for this guy, it is a non-borrow. But for our derivation, we have MBN, right? We have MBN, and we call it the non-borrow monetary base. But for this one, it is the non-borrow, but it is non-borrow reserve. Non-borrow reserve. However, non-borrow reserve is a component in the non-borrow monetary base. So the central bank can perfectly control or nearly perfect controls the non-borrow reserve. Because this one, the central bank can conduct the open market operation to influence the level of the non-borrow reserve. So you can take note that the non-borrow reserve is a component in the non-borrow monetary base. Okay, but for this one, the central bank cannot perfectly control because it will depend upon the behaviors, borrowing and lending behavior of the commercial bank. Okay, I will skip ID. I will talk about the IFF first because ID is another story. So let's see only the IFF. And for this one, as I mentioned earlier, that we have a reserve divided into the non-borrow and borrow reserve. For the non-borrow, it is the component that the central bank control. Okay, the central bank can fully control this. So if we switch back to the derivation here, you can see that when the interest rate changes, it will not affect the supply. Because for this guy, this vertical line is from the central bank. Central bank can perfectly control this component. So here, the distance from the origin, the distance from the origin to describe, we call it the non-borrow reserve. Okay, we call it the non-borrow reserve. Non-borrow reserve. For this one, the distance is equal to the non-borrow reserve. The central bank can perfectly or nearly perfectly control the non-borrow reserve, the level of the non-borrow reserve here. Okay, for this one. Suppose that the central bank conduct the open market purchase, what will happen with this graph? Open market purchase, can you remember this? This is the balance sheet of the central bank. I use CB. And this is the balance sheet of the commercial bank. I use COM-B. Okay, commercial bank. For this one, suppose that the central bank conduct the open market purchase. It means that the central bank purchase what? Purchase the security, right? Purchase the security from the commercial bank. So the security here will decrease, and the security here will increase, right? And what will happen next? The central banks will pay. The central bank will pay for the security by deposit the reserve into the commercial bank's account. Okay, so the reserve here also increase. The reserve here increase, security here decrease, security here decrease, reserve here increase. As a result of this, the non-borrow reserve will shift to the right, will increase. We have here point A, point B. Equilibrium. E stands for equilibrium. Here E stands for equilibrium. Equilibrium from point A to point B. This is the result of the open market purchase. Okay, you can see that we have the reserve here increase. For this guy, it is the non-borrow reserve because it is influenced by the monetary policy tools, okay, from the central bank. And what will so this one open market purchase. And how about open market sales? When the central bank conduct the open market sales, this is a central bank balance sheet. This is the commercial bank balance sheet. Open market sales somehow will decrease the security here. Okay, and the security here will increase. So the reserves here will decrease. Reserve here will decrease. Okay. As a result of this, it will shift the supply curve to the left hand side. Okay. This will shift the supply curve to the left hand side. Why? Because as I mentioned that the distance here is non-borrow reserve. Because the distance here is the non-borrow reserves. And as you can see from the open market sales, when the central bank sell the government bond or sell the security to the commercial bank, the level of the security here on the asset side of the central bank will decrease, right? And the level of the security here in the balance sheet of the commercial bank will increase. So for this one, the commercial bank will have to pay the central bank with the reserve. So the reserve here, this variable is the non-borrow reserve. It's a non-borrow reserve. So for this one, the value of this one represents the distance in this graph. So this is the results of the open market sale. The curve, the money, the supplies of the reserve will be shifted to the left hand side. Okay, left hand side. Okay, but for this one, when the supply curve shift to the right hand side, it is the result of the open market purchase. And you can see for this graph, when the central bank conduct the open market purchase, it will decrease. The level of the Fed fund rate here will be reduced to the IFFB here. When the central bank conduct the open market purchase, it will lower the level of the key policy rate. Okay, of the key policy rate. Conversely, when the central bank conduct the open market sales, it will lower the levels of the non-borrow reserve, and it will increase the levels of the key policy rate to IFFC. So when the central bank conduct the open market sales, it will cause the key policy rates to increase. Okay. So here it is stories of the monetary policy tools and their effects of the tools on the demand and supplies of the market for research. But for this one, I talk only about the open market operation. Why? Because this is the crucial one. The central banks conduct the open market operation on a daily basis. All central banks all around the globe conduct this operation. So that's why this is really important, and you have to understand it from its core. Okay, this is the heart of the monetary policy tools. Okay, the most important one is here. Now let's move on to our slide. If you cannot write it down, everything's here. Don't worry, because I will take a photo for you and I will upload in your Facebook group. Okay, let's get back to computer. Now, next one is very easy because we just finished the most difficult one. Okay, so let's see. That is the stories behind the supply curve and the effects of the monetary policy tool, which is the open market operations on the movements of the key policy rates. Now, as you can observe for this one, we have ID. Okay, we have ID here. What it is? Little I here and subscript D. It is the discount rate. Okay, it is the discount rate. ID here is the interest rate that the central bank will charge the commercial bank when the commercial banks borrow the reserve. When the commercial bank borrows the reserve from the central bank, the central bank will charge this rate, ID. Now you may have some ideas about this. IFF and IDs are different interest rate. Okay, are different interest rate. And for the next graph, for the graph in the next slide, I will put both IFF and ID together in the same on the same axis. Let's see. Here is a complete story. Okay, let's see. On the vertical axis, oops. On the vertical axis, it is the key policy rate. And I also put the discount rate here on the vertical axis too. As I explained, here is a discount rate, which is different from the key policy rate. Because this rate is the interest rate that the central bank will charge from the commercial bank when the commercial bank borrow the reserve from the central bank. So, as you can see for this one, suppose that we start from this point as the reference point. You can see that we will have the portion here. The portion here, I mean that the level that is lower than the ID. For this one, for this portion, how should I write that? I would like to write it on this one. For this one, you can see that, so you should take note on this. For this portion, okay, for this portion, it is the region in which the IFF is lower than ID. Okay, IFF is lower than ID. IFF is the interest rate that the bank charge one another when they borrow reserve from each other. Okay, so it is the overnight rate or the rate of the overnight loan. Okay, the rate of the overnight loans of the reserve. But for this one is the interest rate that the central bank charge the commercial bank. So you need to make sure that you can distinguish these two rates. Okay. In fact, this guy, the discount rate is a little bit higher than the key policy rate. I cannot remember. I think it might be the 10 basis point. I'm not sure about it, or 50 basis point. But this one, this guy, in reality, when you take a look at this in the data, you will find that this rate will be higher than the key policy rate. But I can't remember whether it is 50 basis point or 10 basis point. I'm not sure about that one. But this guy will be higher in reality. So for this portion, the first portion that I try to explain. If you guys were commercial banks, will you borrow from the central bank or will you borrow from your friends? Your friends now are banks. When IFF is less than ID, will you borrow from the central bank? When IFF less than ID, this rate is the central bank charge from you. But for this one, your friend charge from you, or you can charge from your friend. Suppose that you have to borrow the reserve. In this case, will you borrow from your friends or will you borrow from the central bank? Exactly. Why? The cost of borrowing here is lower. So, for this one, in this portion, you can see that the reserve here is the non-borrow reserve. Okay, it is a vertical line. It is a vertical line. And the distance here is a non-borrow reserve. Because changes in the interest rate here will not affect the portion of the reserve here. What next? Suppose that ID. In fact, I'm not sure whether I have to put the equality or not, but anyway, let's play safe. I just will put it this one. But for this one, suppose that we have ID greater than IFF, what will happen? Will you borrow from your friends or will you borrow from the central bank? Exactly. So you can see that when the interest rate goes up and goes up a little bit higher than this threshold, the supply will be a piecewise or a king supply. We have the horizontal line here, and you can see that for this one, from the distance here to this point to this point, we have the non-borrow reserve here. But for the portions in the horizontal line, you can write it down in the slide. If you cannot understand what I say, you can come to me after the class and you can ask me. Okay, let's see. For this one, we have the IFF, we have reserve here. This guy is the ID, right? And I told you that at the level here, you will not borrow from the central bank, but you will borrow from your friend. So when you borrow from your friends, it will not affect the level of your non-borrow reserve here. Okay. But at the portion here, above the ID, we will have the linear line here, which is the horizontal line. And you can see that if we take this point in our consideration, here we will have the non-borrow reserve. And this guy is what? Is the borrow reserve. Because this is the amount of reserve that you borrow from the central bank. Okay? When the interest rate or when the short-term interest rate goes up higher than the discount rate, the commercial bank will turn to the central bank to borrow the reserve from the central bank. As a result of this, the borrow reserve here, the amount of the borrow reserve here will increase. Okay, will increase. It is like a top up from the non-borrow reserve. You may have the non-borrow reserve like this one. You can think of it as the pictures. This is your non-borrow reserve. And it would be logical if we have the case of the IFF less than ID. But when the IFF greater than ID, you will turn to the central bank and you will borrow the reserve. But this kind of reserve, this type of reserve, we call it the borrowed reserve. So this red ink represents the distance here. This blue ink represents the distance here. Okay, we have two types of reserve in this situation. This is the piecewise supply, the piecewise supplies of reserves. Sometimes we call it a king, but when we use the word king, it may have it will have another meaning. But anyway, you should use it the piecewise supplies of reserve. Now we put it all together, which is the supply and the demand for reserve. If you have any question, you can see me after the class because I will try to finish the class before 11:30 and I will let you guys prepare for your presentation. Don't be too serious about your presentation, but anyway, it still have some score for it. Look at me, I am not serious, okay? I'm not serious. I don't know why you guys feel very serious about this. Don't be serious. Make yourself at home, okay? Okay, now you can put it all together. So this is the demand for reserve, and this guy is supply of reserve. Sorry about this one. Okay, this is the mechanism behind the graph. You can see that when we have here, at this point, we have the excess supply. When we have the, I'm sorry about this one. At this portion, we have the excess demand. Excess demand. So when you have the excess demand, it means that we have higher demand than the level of the supply. So it will drive the interest rates up. So the interest rate here will goes up. It follows the normal mechanisms of the demand and supply. For this one, we have the excess supply of reserve. When you have the excess supplies of reserves, it will drive down the interest rate here from I2 to I side here. So this guy's point one here is the interest rate at the equilibrium. This is the equilibrium point. This is the interest rate at the equilibrium. The interest rate that the demand and supply interact with each other and determine this number. Okay. Okay. I will skip the graph because I talked about the open market operation already. Okay, one thing that I would like you guys to take note is that to me, in this course, I will not focus this graph, this portion of the supply. As you can see from the demand and supply curve, we have the key demand too, right? But for this one, I would like you guys to think of it as only the downward sloping demand curve. So you should ignore this RD. Okay? Why? Why I ask you to ignore this portion? Because this happens after the 2008, after the subprime financial crisis. Because the central bank, I think, the central bank just pay the interest rates on the reserve. So RD here or IOR here is the interest rate that the commercial bank will earn from holding the reserve. But in this class, I will focus on the situation or the scenarios before the 2008. So that's why I just ignore this portion. So in our lectures or in this course, we will focus only on the downward sloping portion of the demand. Okay. So when you when you take a look at this graph, please ignore this part. Okay, this guy you should ignore it. Just focus only on this one. For this one, when we conduct the open market purchase, you can see that we have the supply shift to the right hand side. Right hand side. So for this one, when we have the demand and the supply together, the interest rate will go down. So this one pretty straightforward, and I talked about it in details already. Ignore this portion. Ignore this part. This part you can cross it out of your slide. So you can read from the slide here. This is the explanation that I just gave it to you when I derived the supply and demand, okay, of the reserve. If you cannot follow what I said, you can read from it. But if you can follow what I said, you can skip this slide. Okay, now we will talk about the advantages of the open market operation. Here we mean the open market sales and open market purchase, which will directly affect the level of the non-borrowed reserve. Okay, this affects the supply curve of the reserve. The merits of the open market operation is that the central bank has complete controls over the volume, okay, over the volumes of the transaction. It is flexible and very precise. Okay, that is why it makes these tools very popular among the central banks also around the world. And it can be reversed, okay, and easily implemented. As I told you that the central banks also around the world engage in this operation on a daily basis. because it's quickly implemented. This is the most popular one and the most effective one. Okay, let me add some explanation because this is Sunday, so I would like you guys to know something more than in the slide. Okay, let's see for this one. When we talk about the open market operation, in fact, we can group it into two types of the open market operation. The first one is the dynamic open market operation. Okay, and the second one is the defensive, open market operation. When we talk about the dynamic open market operation, it is an operation that the central bank conduct in order to control the level of the non-borrowing reserve. But when we talk about the defensive open market operation, it means that the central bank try to conduct the operation to offset the unfavorable effects. Okay, the unfavorable effects. Suppose that we have the unfavorable shocks to our money supply. The central bank can conduct the open market operation to offset that negative effects. Okay, this is a defensive open market operation. So here is a story of the open market operation that the central banks conduct. The next one, the next one is here. Okay, please cross this one out. We will ignore this part, but let's focus on this one. The next monetary policy tools is the discount policy. As you know, the discount policy here is the interest rate that the central bank charge from the commercial bank. Okay, so the central bank can set the levels of the discount rate. However, the central bank cannot expect the effect much from the discount rate. Why I said that the central bank cannot expect the effects from these tools much? Because as you can see, when the central bank lower or increase the level of the discount rate, the central bank cannot control the behavior of the commercial bank. Okay, the central bank cannot control the behavior of the commercial bank. You can think of it that the central bank just change the interest rate, but the central bank cannot expect whether the commercial bank will come to the central bank and will borrow from the central bank or not. So that's why this is another tool, but it is not that popular compared to the open market operation. And as you can see for this one, if we lower the level of the discount rate, but it is not lower enough, you can see that it will not affect the level of the interest rate. Okay, it will not affect the level of the interest rate. Oops, what is this? Okay, because this is Sunday, so I will add something more into this. Okay, let's see for this one. But this one you can take it as a side note. We have here the demand and the supply, IFF, ID here. This guy is the reserve. We have here as a demand, okay. Suppose that this is the supply curve, and here is the interest rate at the equilibrium, IA. And when the central bank lower the discount rate somewhere here, it will not affect the level of the I star FF here. Okay. However, when the central bank lower the discount rate, what happens? It will influence the level of the IF in this case, if the central bank lower the level of it, and it is lower and in this portion, the short-term rate or the key policy rate will be equal to the discount rate. Okay. Okay. Yeah, you can take it as a side note of this one. Otherwise, you will see that there is no effect on this. Okay. So the central bank, if the central bank would like to influence the equilibrium interest rate of the Fed fund rate or the key policy rate, with this tool, the central bank has to lower it larger enough in order to influence the level of the key policy rates. Okay, it will be that case. Okay, discount policy. Sometimes we call discount policies as the discount window. You can think of this as in fact, it is the ideas of the lender of last resort. Okay, lenders of last resort. The central bank is the bank of the commercial banks. When the commercial banks need to borrow or need to conduct some transactions, it will have to go to the central bank. So the central bank will be the bank for the commercial bank, the bank for the commercial banks. So the central bank will be the lender of last resource, and it will provide a discount window, which is the reserve, okay, which is the reserve to the commercial bank. And so the central banks perform the standing lending facility to the commercial bank. We call it the primary credit. Okay, it is like a backup source of funds for the commercial bank. When the commercial bank has some problem, it can go to the central bank. So we call it the primary credit or standing lending facility. In fact, the standing lending facility has nothing to do with the banks that have the trouble. Okay, this primary credit is just to back up the reserve for the commercial banks. To me, in my opinion, I think the primary credit here will help the public, will ensure the public will ensure the expectation of the public, and the general public can think of this primary credit as when the commercial banks have some problem in the balance sheet. Okay, the central banks at least they can, the commercial bank at least they can go to the central bank to borrow, right? So this will ensure the expectation or ensure the belief of the general public to the commercial banks. So that's why we call it the standing lending facility. Okay, standing lending facility. It is just a backup. Okay, just a backup fund for the commercial banks. So the next one is the secondary credit. Now this one we turn to what we just studied in the banking management. For the secondary credit, when the commercial banks experience the liquidity problem, or when the central banks have some troubles in the balance sheet, the commercial banks can go to the central bank and borrow the reserve from the central bank. So the secondary credit here is a function of the central banks as a person who help the commercial bank when they have the problem or when they have the trouble. So the secondary credit is different from the primary credit, because for this one it is just the lending facility. It's just a backup, okay? But for this one, secondary credit, so you have the problem now and you have to go to the central bank. So this one is the secondary credit. And the next one is the seasonal credit. This one is a less popular term, but you can think of the commercial banks in an agricultural areas. When people are farmers or people earn their living through the agricultural products. Sometimes they have the money and they deposit the money with the bank. But in some seasons, they cannot deposit the money at the bank because they have no money. Why? Because they make a living based on agricultural products. And agricultural products tend to be the seasonal. Okay, tend to be the seasonal. So that's why for this one, it will somehow affect the balance sheet of the commercial bank too. And the central bank will somehow help the commercial banks who experience the seasonal credit like this one. However, when the central bank use the discount policies, it just perform the function and the lending of last resort, as I mentioned. However, this one is somehow is okay. However, these tools cannot be fully controlled by the central banks because the decision borrowing and lending is based on the commercial banks, okay, not the central bank. And I think for this one it will be okay with the discount rate. Okay, the last one. The last one here is the shift in the demand. It is only monetary policy tool that will affect the demand curve. For this one, it is the required reserve ratio. Suppose that the central bank increase the level of the required reserve ratio. It means that when you guys are the depositor, deposit the money in the commercial bank, the commercial banks will have to keep a larger fractions of the reserve. We call that larger fraction the required reserve. Right? As a result of this, it means that the demand for reserve also increase. It will shift your graph to the right hand side. It will shift the demand curve to the right hand side and keep other factors constant. You will see that it will increase the level of the interest rate. Okay. For this one, please ignore this one. This guy you can cross this out because I just put it to make it complete. Nothing much, nothing less. Okay. Okay, this one you can skip. Okay, talk about this one. Disadvantages of the required reserve ratio policies or the reserve requirement. In fact, this monetary policy tool is recommended to eliminate. Okay, for this one, it's recommended to eliminate. So that's why I think I just give you the idea and I will skip it. And so to sum up, the monetary policy tool that you have to make sure that you fully understand is the open market operation. The effects of the open market purchase, the effects of the open market sales on the supply of reserve. Okay, so you need to make sure that you fully understand that part. For this one, I just want you guys to know that okay, which will eliminate it in the near future or something. Okay, this one will be okay. Okay, next. This one is the unconventional monetary policies. The first part that I talk about is the conventional monetary policy tools. Okay. Would you like to have a break? Yes. Okay. So we will have 10-minute break. Okay. Let's get back in 10 minutes. Okay.